Hello, everybody. So I finally got around to listening to STEM's Q1 conference call and studying their results, and I like what I see. So let me just go through everything, and I think there's quite a bit actually to update you on. So first of all, STEM reported Q1. They beat their prior guidance, which is great, and they have been showing great numbers. First of all, for example, software services grew at 14% quarter over quarter. And keep in mind, these quarter over quarter numbers, if you analyze them, they'll be very high, well above my 30% threshold. For 14%, that's like well above a 50% threshold if you analyze that. So that's really impressive. They were also awarded the best virtual power plant, largest virtual power plant provider in North America. So they're definitely squarely fitting in that virtual power plant thesis. They reaffirmed their guidance at a 65% revenue growth that they're expecting for the full year of 2023, and they're expecting even more accelerated service growth this year, and that's always the thing that analysts push STEM on, and I kind of agree, which is, you want to see a lot of software sales growth because that's where the gross margin is. There's very little money to be made in installing and setting up and being an engineering firm setting up the systems. The money is really in the service. Let me move on. Lots of good things, right? Growth in the services revenue for solar and storage is high. So it's 22%. And keep in mind, the business is still mostly storage. It's 22% quarter over quarter for storage services, 7% quarter over quarter for solar services. They're going through a solar recovery. If you remember, solar wasn't doing too well for them. Contracted backlog is up 120% year over year. And the backlog is huge for them because nobody can get their hands on these batteries, right? There's very little supply for these batteries. And then you also have to wait forever to get connection to the grid. Anyways, that's one of the issues why there is a backlog. This is a very compelling technology, but you're getting into the hurdle of supply chain and into the hurdle of administration to actually execute on these contracts. A lot of customers are also standardizing, as they say, on the Athena platform, which means that they're being proficient, they're being happy with it, and they're continuing to operate on the basis of the Athena platform, which is their software platform for managing battery storage, for reselling energy to the grid, etc. And they expect actually even more deals, software deals and professional services deals in the coming quarters, which is again it's definitely a development in the right direction. The solar business is recovering 4% quarter over quarter. They still have a backlog, but there's issues with supply chains and labor shortages on solar, and especially getting the solar out of China and getting panels at scale out of China into the US, because there's not enough panels made in the US. They've announced what I think is a wonderful partnership for their partnership with EV charging. So they have a partnership with InCharge. But when you do EV charging, right, the charging of electric trucks, you need a big battery. Because if you don't have a big battery, you're not going to be able to charge these electric trucks fast enough. And of course, STEM is the leader in setting up these batteries at corporations that are necessary in order for manufacturing facilities to be able to charge these trucks. You can't have a truck electric charger without a big battery next to it. And that's what STEM provides. And they have this partnership with Sysco. And Sysco could have, they said in the call later, like 2,800 different trucks. So that's going to be a lot of EV charging infrastructure. And they're going to play a role in that EV charging infrastructure on the battery sides, setting up different systems, not just Tesla battery packs, but other battery packs as well. But keep in mind, they're still the main installer of Tesla megapacks. So it's still a major share of their business, which is why I'm always hesitant to consider STEM a competitor of Tesla. They're more like a co-competitor. They compete on a few things, but they also cooperate because they're a huge buyer of megapacks. Anyways, let me move on. Speaking of supply chain, right? So getting your hands on the battery is the big issue. I mean, this company, this is a software company, but you can only sell your software after you install the battery storage system for industrial applications, for utilities. You can only sell your software after you've installed it, right? And the problem, of course, is that getting your hands on these megapacks is a very long lead time. It's complicated. I mean, if you go on the Tesla website, delivery is like something in 2025. So we have issue with supply chain, and I think part of the expertise of STEM is really understanding the Chinese manufacturer and being able to know these contacts. Like, contacts are valuable. How do you know which manufacturer of battery packs is reliable? Clearly, it's not as simple as just going on Alibaba and spending $1.3 million to order a battery pack from China on Alibaba in a container that comes 2 months later. It's clearly much more complicated than that. There's a lot of strong network ties that are being developed between the leadership of STEM and the actual Chinese manufacturers. And there were 2 weeks in China in March. The leadership team was 2 weeks in China in March, actually developing these relationships with Chinese makers. And if you understand, like, at a deep level how doing business in China works, this is important, right? Because we have this whole concept in China of guanxi, I believe they call it, which is you need to develop trust before you go into a contract. And of course, if you're going to be ordering a bunch of $1 million battery energy systems, you better have strong ties and strong relationships. A local utility or a local industrial building in the US is not going to have those relationships. STEM is building those relationships, and so I believe this is more valuable than a lot of people think, to understand how to navigate the Chinese landscape of purchasing batteries. And by the way, I mean, someone asked the question on the call, when are you going to have more batteries in the US? And it's like, yeah, there's a few plans, but it's by 2025. You got to wait at least until 2025 for these factories to even be built. So it's capacities in China. You really don't have a choice for batteries right now. So moving on to the financials. Financials always the exciting part, right? When we talk about these businesses. So revenue growth is quite high at 63%. But beyond revenue growth, there's a few more things. And that's year over year, of course, 63% year over year. There's a few more things that we need to talk about. So adjusted EBITDA is a little bit down, but that's not too meaningful. Just one less million in 2023 and 2022. Adjusted EBITDA is a good proxy for cash flow, and they've guided for that for 2023. So we'll look at the guidance in a bit, but it's not too meaningful. I think one of the things that could spook people, and that's why I put it in the thumbnail of this video, is the gross margin really 1%? Because GAAP is what's going to be advertised, and critics of all companies, and they're going to use GAAP, and they're going to say, oh, this is the real margin. Oh, GAAP accounting makes sense. No. GAAP accounting makes no sense, absolutely no sense. And if you go back, you really obviously, in my view, have to use non-GAAP, because you have this beautiful thing called phantom expense. These are not real expense, right? If you look at amortization of capitalized software, that's not a real expense. That's a fake expense. That expense only exists in the eyes of GAAP, and it only exists to pay your taxes, right? So you need to always use a grain of salt when you use GAAP margins. I hope I don't have any accountants hating on me here, but you have to, you look at it as a finance person, and if you look at it as the finance person, their gross margin actually pretty much remained more or less the same. But the reason why there is such a huge delta between the GAAP and the non-GAAP gross margin, which actually went up a little bit, but we'll see why by the end of this video, is this whole idea of revenue constraints. So if you look, and this took me a while to figure it out, but if you look at the numbers that they've put out, they have this revenue constraint, which is 10.2 million, and they had a big customer that they could not recognize all of the revenues that quarter, and they're going to have to wait for a few quarters to recognize this revenue. So that's why the GAAP gross margin right now is showing so low because they were not able to collect all of the revenue, yet they incurred all of the expenses up front. It's obviously not ideal when you have to put the capital up front and get paid later. But as they noted in the call, this is a one-time thing. This is not going to be an ongoing issue. In the future, this revenue constraint is built into the revenue, and they will charge the revenue as they go. So, in conclusion, the non-GAAP gross margin that they're showing, and that slight increase from 2022 to 2023, is correct. But because of GAAP accounting, you have to report that drop, and that's just one of the artifacts of GAAP accounting. It's okay. It's not a big issue. Let me move on to more exciting things, which are the growth numbers. So their backlog. I mean, who knows? Like, it's like who knows if how much of that backlog they're actually going to be able to do, because when you have such a huge backlog at $1.24 billion, I mean it's likely that your customers are trying to find a way to get it done sooner, and it's really the supply chain, and maybe they can contract with someone else, or pay breakup fees on that contract, move on and have another battery supplier. So always take backlog with a grain of salt. It's not as good as actually realized revenue, but it's a good indicator of how much demand there is for this product. There is major demand for the product. What's more exciting to all investors, and obviously, if you buy STEM, I don't think you're in the engineering of solar storage system and battery storage system. That's not the business you want to be in. You want to be in the software business, because that's where the money is, right? And their software business is wonderful. The annual recurring revenue ARR, right, is up 11% quarter over quarter. And if you look, they expect 52% growth in ARR. So the ARR is on track for this full year at $80 to $90 million in ARR. And why is this exciting? Why is that growth level exciting? And by the way, this may move up. One analyst asked them in the call whether they were considering updating guidance up, and they're like, "Oh no, we're not doing that." Well, I understand why, because they don't want to set themselves for disappointment with the market. But it's like it's possible that they're going to do better than that guidance. Anyways, why am I excited so much about the software growth is because obviously, you may remember this from a former video, it's an 80% gross margin secured by a 5 to a 20-year contract. So this money is spending a lot of money up front, setting up everything. But once it is set up, you're going to have a very long-term contract. And, come 15, 20 years from now, it's very likely they'll renew with Athena. These things are pretty sticky, right? Once you have a software and you operate your battery with a software, that's a really sticky thing. You're not going to want to take the risk to change software. If your business has been doing well and working just fine for 10, 15, 20 years, are you going to take the risk to switch up that software? Probably not. That's why so many companies still use SAP, even though SAP is not that great of a product. Anyways, moving on. It's not a video about that. Trying to stay on topic here. Okay, what I love, and I know they've announced this a few weeks ago, but they announced it on April 3, so a few weeks ago, so you may be aware of that. But I hadn't bought the stock, so I took kind of some time off studying this stock. But I'm looking into this now, studying this now, and I am absolutely loving this. The green convertible senior note. First of all, green convertible is just a way for them to market this better and get better rates, because there's a cohort of investors out there who are willing to take a lower rates to invest in renewable energy. So this is good for them. They're charging less, but that's nonetheless not the bigger issue. They were able to, not only did they raise more cash that they needed, and that's $106 million of cash extra, which they haven't spent, and they're not planning on spending anytime soon, by the way. They said that on the call. It's just in case, money for later. And why wouldn't you, at this rate, why wouldn't you borrow more money? I kind of understand where they're coming from here. This is a great rate, but this is what they did, which is stunning. They, in exchange for paying a little bit higher interest rates, they were able to buy back their old debt at a very, very, very steep discount, and they were also able to buy some capped calls to mitigate dilution. So this is a wonderful thing. What's happened is, since this company is so depressed in the market, any financial instrument attached to this company is also going to have a depressed valuation. But economically, this company is not as broken. So this company can go out and issue more debt to buy back old debt that is trading at very depressed valuation. And I really wish we could all do this. I really wish we could all do this, because all debt dropped tremendously in value with interest rates being so high. Anyways, this is absolutely wonderful what they did. I love the green bond here. When I look at the stock price, I'm pretty sure the market saw this as, oh, we're running out of money, oh, we're in trouble. The market's wrong on this, because this is actually a pretty darn good operation, and we saw if you follow Open Door, one of those other stocks I like, they did the same thing. So we're seeing a lot of companies do that, and that's great. That's absolutely great for us investors. By the way, I'm just disclosing this right now. I'm gonna be buying STEM after this because I do like what I'm seeing here. Okay, let me move on. So with a new capital issuance, and they have a new cash position, right, at 312 million, and they have to worry about rolling over the debt now in April of 2030. So let's go back to the guidance. They haven't changed the guidance. They've left it the same, reiterated it, but this is what's important to us, is the adjusted EBITDA. So let's assume worst case scenario, negative cash flow, and I'm using adjusted EBITDA as a proxy for cash flow. I know it's not exactly the same, but it's close enough. And if you use minus 35 million for worst case scenario for adjusted EBITDA, so that means you would have actually a 9-year runway. So a 9-year runway, $312 million at this cash burn, that's going to last you 9 years, which in my view is it's plenty of time to scale, more than enough time to scale. They actually would have just a tad less than 9 years, of course, because they would have to roll over the debt in 2030. But that's I mean, to me, this is not a company that has bankruptcy anytime soon, contrary to what the stock chart or the price action would suggest. No. This is a company that has cash. Let me finish this video with some nuggets from the conference call. Listen to the whole conference call. As always, there were a few questions about the software. Anyways, one analyst asks, what's going on with software? We want more software. And they said, oh, yeah, we may get more software. There's more uptake of software, but we're not putting it into the guidance. Classic back and forth with analysts. This question seems like a blanket question just for the sake of asking a question. Are you impacted by the banking crisis? That was really the question they had. No, they're not impacted by the banking crisis, and their customers are not impacted either. If anybody was wondering, I thought this question was not very targeted. It's probably a question the analyst asks everybody. Anyways, moving on. They haven't spent the 100 million. They're being very careful. I think it's great that they are being very careful. They're expected to have more asset under management for their software going up. That was another question about software. The analysts really keep pressuring them on software. I mean, the management got the message that software is what the analysts are going to ask. These were the first questions of call. Software. Anyways, moving on. What about the supply? I think this is a more relevant question, because once you understand the business model and once you're patient with software, software will come, right? It's about understanding the business model, but the market obviously wants everything now. We want software now, is what the market is saying. But if you understand the business model, you understand that you can't sell software if you haven't sold the battery storage first. And so that's why I think these questions are more relevant right now, the supply question. So again, their supply is essentially Tesla and China. It's Tesla in the US, Lathrop, California, and then it's the China megapacks. That's where the supply comes from, essentially. And there's no major change. So since there is no major change, that means Tesla is still the number one provider of megapacks for them. But still, they are still the number one installer of Teslas, and China is probably about half of the business. That's what I saw from the last call. They do about half and half, a little bit more Tesla megapacks, and understandably, it's the only one that's available right now, and it's in the US. Right? If you buy something from China, you have to ship it. Takes a while. Anyways. But they're desperately, and the CEO seemed on the call, you could tell on the tone, you can tell a lot with tones of CEO on the call. They're looking, they want more. But the problem is that most of the planned plants would open in 2025. And then if they open in 2025, you would have to assume that you would be getting the first batch of batteries. So hearing these statements is extremely bullish for Tesla, because Tesla is the only game in town for 2 more years, maybe more. So this is extremely bullish for Tesla. I'd be curious to see if there is a main maker of megapacks in China, and who are those. And STEM is obviously very secret on their list of how they buy and how they supply. That's why I say those contacts are valuable. They're very secretive about that, at least in my research. Okay, gap margin, we've already discussed that. Yes, it's a one-time thing. Anyways, they ask about seasonality. This is very interesting if you're interested in the seasonality of this business. The conclusion about the seasonality is that their sales cycle pretty much tracks the construction cycle. In the South, of course, the construction cycle, there's not really a construction season in the South. You build all year, but, most Americans live in what I like to call there's like a windshield from like Vermont. You do like a 1,000-mile windshield, and that's where most of America lives. And in that area, there is obviously a construction season, because you can't really do much when it snows, right? If you lived in a place with snow, the construction slows down in the winter. So they have some seasonality in the revenue because of the winter, and few projects happen in the winter. One of the bigger issues for them is, of course, the permitting slowness, and this is something that they've noted multiple times, and that's especially true in solar. You're moving at the pace of government. 75% growth rate for services is still on track, so that's very exciting. Battery procurement, that's one of the big issues. It's capital intensive. They went a little bit about their contract, how it works. They typically pay 30%, and then as the rest as the project is getting installed. They also talk about indexing the product on lithium prices, and there's different clauses in the contracts. It's a very complicated sales process. This is definitely, when you sell a multi-million-dollar product, you're going to have some of these things included in a contract. A little bit too much of a minutia for me. This is not as relevant to me, because I'm more interested in the big picture. This is just minutia here. The margin profile is going to be higher on the backlog. Again, more of a minutia. If you're confident about that should be all okay. I clearly see a path in margin not being in setting up storage system. The margin comes from selling the software after setting up the storage system. It's kind of like selling a Roku device, like a Roku stick for TV. You're gonna make no money on the Roku stick, but then you're gonna make 10 years of ad money. That's kind of the same thing. Nonetheless, they did put some incentives to compensate employees based on the gross margin that they achieve. Yeah, it'd be nice if you didn't lose money. You want to at least get to cash flow break even. But that's also another point I want to say about batteries. Batteries are a commodity, and because they're a commodity, you're going to have a really hard time creating a brand. So the margins are going to lean towards zero. What is not a commodity is the software. That's what's not a commodity. That's where you make the money. But eventually, a battery, once it is set up, it is set up. You're not going to have bragging rights for having a certain battery brand or anything like that. I guess you could make a case Tesla a little bit, but even then, it's that probably makes sense. Commodities, batteries are commodities, and commodities you don't make much money. Commodities over time, profits tend to get to zero over time. This was more interesting. This is kind of a nugget right here. This is a nugget. So they're moving up in project size. There's a lot of reasons for that. Of course, a bigger project means bigger software revenue down the road, so that's good. But there's another reason. They're moving up because if you move up, then they don't have to buy the equipment themselves, i.e., they save that cash for other purposes, right? And so over time, they expect revenue growth to lose some meaning. And their revenue growth is still extreme. But that revenue growth will lose some meaning if they are not the purchaser of record for bigger projects, right? If bigger projects, if it is like, if you sell to a utility a battery, and you have the utility do the payment for that battery directly, you don't need as much working capital, you don't recognize as much revenue, and your profits become much higher, right? Because it's more engineering fee profits, it's more service profits, because you don't have to outlay that amount of capital to buy the battery, carry the battery on your books, and then resell it, right? So the fact that in the bigger project setup, it is the utility, it is the industrial project that actually goes out and buy the products themselves, that actually leads to smaller revenue growth for them. But that's unprofitable revenue growth anyway. So it's gonna lose some of its meaning. And I thought this was a little bit of a nugget. So in a few years, if we see revenue slow down, this is something that we'll need to pay attention to and keep paying attention to, because we have to see if they're not the purchaser of record anymore, the revenue is gonna go down. But that's going to be okay because the margin is going to go way up. And that's why I use gross margin in all of my metrics when I analyze stock. Software pricing, they're holding firm on their software. They actually had a price increase last year, didn't lose any customers, and they're not negotiating prices down. I think it's a clever thing to do. They have valuable software. Customers once they have that software, they're not going to switch. It's too complicated. Solar supply chain is improving. Battery continues to be good. Their main issue continues to be the pace of the government and connecting to the grid, and this is especially true for solar installation. It's a major issue. They can't get connected to the grid fast enough, and it is a risk, right? It is slowing down the growth. The fact that you can't get connected fast enough. They said utilities need to hire, and my guess is that this will be resolved with time. And lastly, and I'll finish with this, and this is important to me, is the view that the opportunity of EV and EV trucks. EV trucks, if you're going to have an EV truck, you need to have a battery system. And if they are experts in setting up these battery systems, and if you look at Sysco, which is a new customer win for them, Sysco alone will have 2,800 trucks by 2030. So imagine how many behind the meter batteries they're going to sell to support the charging infrastructure. And I believe this is going to be a major tailwind for them. So in conclusion, I'm very optimistic about STEM. I like this call. I like what I saw. A lot of my concerns are being alleviated, and I'm slowly moving towards the idea of purchasing this stock. I will be making a few other videos, one specifically on valuation, one specifically on my decision, but I love the direction that STEM is taking, and I've always liked STEM. I mean, I put it in my too-hard pile because there's so many moving parts, but the more I study this business, the more I like this business. Let me conclude. Not investment advice, never investment advice. This was just entertainment. I hope you were entertained. Thank you so much for watching. I appreciate your likes. I appreciate your subscribes and your comments and your support. Thank you, and have a wonderful day.